so far, what is your takeaway on earnings, especially when you look at the guidance and the earnings guidance for 2019 that we've gotten so far? I mean, just in the last 12 hours, 3M, Harley, Polaris, Pfizer, Whirlpool, even to a certain extent Lockheed Martin, all guiding lower than expected.
Sure. I would say that earnings are, without a doubt, disappointing. I think one thing is to focus on the headline number, which is about 15% is what it's likely to come in. But I think you've got to keep in mind, what are underlying earnings doing. So these are Q4 earnings. In the first quarter, we're going to get a 10% lap from the cut in the corporate tax rate. We've had movements basically in the US dollar and oil prices. You adjust for those two things, and we're talking about underlying earnings growth, from a forward-looking sense, you're talking about 4%. That's, pretty steep decline from where we were running in the first 3 quarters of last year at around 11% and pretty steady. So the slowing is pretty sizable. It's pretty disappointing earnings. But I would argue, a lot of this is very well priced in. The market's up almost 2% since this very disappointing earnings season started. And there's plenty of things that suggest basically, the market is more likely than not to actually creep higher rather than lower near term. Yeah.
Jack, what's your takeaway on earnings so far? And particularly this idea that we're seeing a slowdown in earnings growth. You even have this growing debate that we could potentially see an earnings recession. Are equity valuations still too high right now, especially when you factor in a Fed that, despite some more dovish commentary recently, is still tightening?
Well, yeah, it really, a lot that does depend on the Fed. Normally, I would say interest rates are still below where they have historically been relative to economic conditions, but perhaps current conditions warrant lower rates, and if we do get an easier Fed and perhaps easier central banks worldwide, that could support, what I would call fair valuations. But I think the other thing we have to keep in mind is that slowing growth and retrenchment are two different things, and I think going into this year, the equity investors had priced in a retrenchment of growth to actually negative growth. And even if we look out for the rest of 2019 and look at low to mid single digit growth, we don't see necessarily an earnings recession here, at least in 2019.
Yeah, Binky, it seems like mid-single digit percentage gains in earnings, if the market is roughly priced in that zone, there's a path there, right? If the Fed kind of is not perceived to turn hostile. What about 2020? I know 2019 just started, but it's almost as if investors would be fine with this being a lull in earnings growth or a steady state plateau in low earnings growth. But are we still going to be reminded that it seems late in the cycle all year?
Yeah, we are big believers that the business cycle is what drives equities. And, I would remind everybody listening that this is, to be very precise, the 8th time in the last 9.5 years that the equity market is essentially priced in the end of the economic cycle. And that by itself, no matter what the fundamental arguments are, should keep you a little skeptical that this is the end. In terms of thinking about the cycle, we can discuss this, of course, in great detail, but I would say that there's nothing that really sticks out besides the fact that it is, on track to become very shortly the longest cycle. And I would point out that, the end of this cycle was pronounced back in 2010 in the summer. We're still debating this 9 years later. Sure. So we do need a few things to get growth back up, but, there's necessary and sufficient conditions, and I think it takes a little while, but I'd still put my money on it happens rather than it doesn't.
Jack, what do you want to see out of the Fed meeting this week?
Sure. I mean, I'd like to, continued recognition that economic conditions are okay, slowing, no risk for necessarily recession around the corner, but no inflation either. So, I'd love to just see a Fed stand pat. That said, I think we are going to start to see a rotation out of, and we're already starting to, out of these large cap growth names and into more smaller cap, domestic focused, value-oriented, something that very similar to what we saw in 1999-2000, when the Fed kept rates artificially low through Y2K, and then started ratcheting rates and trying to normalizing rates. Back in those days, we saw a huge surge in value, and in fact, value investing outperformed growth for something like 5 or 6 years from 2000 onward.
A long time ago, it feels like. Binky, finally, you did, in answer to Morgan's question, say just a moments ago that there are many things that suggest the market will creep higher. So what are a couple of those things?
So in the near term, essentially the market is, priced for a lot worse, and that's why you're basically seeing, whether you think about it in terms of earnings growth. So, the way that we read it, we're getting underlying earnings growth of 4%, which is the way you want to think about earnings growth going forward in the very near term. But the market's basically priced, I would say, at current levels, for about minus 5%. So, just a rally basically from a fundamental point of view on things are not as bad as feared. Number two, of course, is positioning. If you look at positioning, Christmas Eve, we're basically, at the bottom of the 10-year range. We've crept a little bit higher, but we're still at the low end of the range. So, even moving to the middle is going to give you, upside. Vol's been elevated for quite a while. Yeah. Generally, when you get a big vol disturbance, it takes, up to 6 months for it to get back down. And as that happens, you're going to see systematic strategies reallocate back into equities. We have, at the end of this week, the buyback. I did say there were a lot. The buyback bid comes back, so that's also modestly helpful.